Welcome to tonight's live stream. Haven't seen you in probably 40, 50 days, I think, since the last time we did one of these. Little summer break, but we're glad to have you tonight because we're going to discuss advanced trading strategies for portfolio management, and the goal of all this is to help reduce risk. I can't tell you how many conversations I've had with clients during the COVID years of 2020, during the 2022 stock market correction, of Troy, how do we mitigate risk? How do we have an active management strategy in place where we can reduce volatility, get ahead of where the puck is going, metaphorically speaking here, and what does that look like? So we're going to lift the curtain a little bit today with some advanced and more tactical trading strategies, discussing concepts, discussing how they apply to portfolio management. Of course, we're not going to give away the secret sauce, but we're going to discuss how these strategies and tactics can reduce risk in your portfolio and hopefully help you sleep a little bit better at night when those economic storms are brewing on the horizon. With me, as always, our Chief Investment Officer, Mr. Chris Paris, and our Director of Investments, Charles Scavone. Okay, so what we want to do is start with just a recap of the quantamental process that we use here at Oak Harvest to identify good stocks, bad stocks, and opportunities. Then from there, we're going to expand down into when we identify bad stocks or when we identify opportunities in the marketplace, how we can use some of these advanced trading strategies to either mitigate risk or enhance potential return. Okay, so Charles, I'm going to go down here. I'm going to start with you. Quantamental investing, the process that we use here at Oak Harvest Financial Group. Just briefly for our new viewers, what is it?
Okay. So we're all bombarded with so much information every day. You have to figure out how to manage that, right? So as a financial analyst or a fundamental analyst, how do you consolidate this data? Use a computer to help you, right? So you use a quantitative process that helps you take a very large universe of companies, financial metrics, boil them down into what's most important, right? We're growth investors. We're interested in corporate profitability. What affects corporate profitability? Sales, margins, return on invested capital. So we ask the computers to look for these attributes, where they're changing, where they're improving, where they're declining. Show that universe to us. Takes 10,000 stocks down to a couple of hundred. From that point then, Chris and myself and the rest of the team put on our fundamental research analyst hats on as CFAs and the like. And we say, okay, well, what's driving these factors? Were they one-time events? Are they sustainable? What's this company done? How good is management in sort of building and maintaining this moat around this engine of growth? And how do you price that up in the market? So it's a combination. So what it is then is a combination of quantitative process combined with fundamental research analysis to build our quantamental approach.
So just in short, just to summarize there, what we're doing is taking a quantitative approach combined with a fundamental bottoms-up type approach to look at the entire universe of stocks that are out there and then whittle it down to a much, much smaller universe based on certain drivers of corporate profitability. And those primary drivers of corporate profitability, of course, are increasing sales, increasing profit margins, and management's ability to reinvest capital at higher rates of return than otherwise.
Yep.
So that's what we call SMR, so sales, margins, return on invested capital. Then the quantitative side, or excuse me, the fundamental side of things, then that's the stuff that most of you at home, you really don't want to do. That's hopping on conference calls, that's listening to what CEOs have to say, that's using decades of experience and identifying things that may seem a bit peculiar or out of the norm, but also just the basic fundamental bottoms-up analysis.
We've talked about this a lot. Chris and I have listened to so many earnings conference calls. We almost know by the type of music they play as an intro, sort of what the tone of this thing's going to be. But what are inflection points? What are company management saying? How's their sort of you can assess their body language via a call.
So real quick, how many high-frequency trading firms automatically buy or sell based on the intro music to conference calls?
I'm sure it's factored in somehow.
Yeah, it's looking at transcripts of conference calls. It's looking at balance sheets, cash flow statements. It's the nitty-gritty behind the scenes once we cull the universe of stocks out there down to a manageable level. And this gets to, it's not about finding bad companies or good companies, right? They're not bad companies and good companies generally, but there are bad stocks and good stocks.
Mm-hmm.
And we're trying to differentiate between good stocks and bad stocks, not good and bad companies, because there are a lot of great companies out there whose stocks do nothing
Right.
for 1, 5, 10, 15 years, and we'll show you one of those coming up here a little later in the episode. But we're just trying to determine, what companies have sustainable growth, accelerating growth, better return on invested capital.
We find that what Chris said just should be reemphasized, because we take a very objective approach to what we do, right? We never, ask us, either one of us, what's your favorite stock? Well, it's whatever one's making us the most money on a given day, right? There's no favoritism applied to it. We're looking for good investment ideas. Don't get emotionally attached to anything.
Yeah.
And then most of us here at the company, we know on a day where something maybe isn't working the way we expect it to kind of give the investment team a little bit of space back there, because your least favorite stock is the one that maybe had good earnings, had good revenue on the conference call, but then they reduced guidance by maybe 5% or 10%, right. And then all of a sudden after hours the stock's down 10%. You wake up the next day, it's same thing. So the most favorite stock, least favorite stock, those can change day in and day out.
Yeah. I mean, we have clients who come in a lot of times and they'll look at their holdings, and there'll be 35, 40 holdings in the company, and they'll want to focus on the red company that the market's up XY, 10%, and the stock is either down or flat or something like that. Listen, as portfolio managers, we do the exact same thing every night, every day, right? We tend to focus on what's going wrong as opposed to what's going right, because if you minimize the mistakes, you can generally maximize the returns. So, we're human beings just like you out there. We make mistakes. We try to adjust and react to those mistakes and minimize them as much as possible. But everyone's human. It's a tough job.
It's a continuous learning experience.
It is after 35 years.
I used to tell people, it's like, if you get in the ring often enough, and you see, every once in a while you learn to see that punch coming and get smart enough to duck every once in a while, because it hurts to get hit in the face.
Yeah, actually we talk about this a lot. One of the interesting things about being in this job and in this role is that what people don't see when they look at their portfolio is the things that you did correctly that aren't in their portfolio.
Right.
The stock that's down 50% that's in the S&P 500 that you didn't own because you saw that it was deteriorating business fundamentals. And it doesn't mean it's a bad company, it's just a bad stock at that time. And you avoid it, but you don't really get, you don't get the pat on the back that, hey, you did a great job by not owning that dog that was down 50%.
And we talked about this recently with bonds. So, you don't get any credit for not owning 10, 20, 30-year bonds 2-3 years ago, because those bonds were down 10, 15, 20, 25, 30%. But at the same time, no, you don't get credit for not having those. Right. But at the same time, leading into it, because we always want to be where the puck is going, right? And sometimes that means dealing with a little bit, or having patience for 3 months, for 6 months, sometimes 12 months before what you're seeing, identifying where you believe that puck is going, before that actually starts to transpire and the benefits of what you are doing can be realized.
There is a fine line in this business between being early and being wrong, right? And we do it whether it's in the stock market or bond market, but a lot of people will say, hey, I was just early. Well, if it's 2, 3, 4 years, no, you were wrong. And because the market continued to go up and stuff. So if you're going to market time, if you're going to make tactical adjustments, you not only need to be correct on price, but also time. Otherwise, you're wrong, and we have to admit it.
Okay, so let me bring this back on track real quick. So that's a recap of the quantamental process. It is looking at not only the fundamental side of things, but also the quantitative side of things, and wrapped together, trying to whittle down a universe of stocks, which we have actually a prop here on the table, which is representative of our universe of stocks. And we're going to get into a couple of examples. We're also going to have a raffle. So we're going to do a raffle. halfway through, and then also at the end of tonight's presentation. If you've registered, you should see it across the bottom of your screen there. You have an opportunity to win a $100 gift card to your favorite restaurant of choice. Our marketing team will reach out to you. We're going to read off the raffle. I'd say in about 20 minutes here. Patrick, our intern, is right here behind the camera, and he's going to raffle it off. So you have an opportunity to win not once, but 2 winners tonight. So, okay, we're going to get into the universe of stocks. We're going to make good use of our props that we have on the table here. But before we do that, let's really talk about, Eric, can you go ahead and pull up the SMR long chart? So what we want to look at here is when we're going through this quantamental process and we're whittling down thousands and thousands of stocks into a universe that meets some of the standards. Not only do we identify companies that meet the standards, but we also identify companies that do not meet the standards. So first, if you want to go ahead and pull that up, what we're going to show you is how SMR can identify companies that have increasing sales, increasing margins, and also an increase in return on invested capital. Do we have that up?
I think we're up.
Okay, so we have it at the bottom. Okay, so I'm going to give the narration, and I'm going to allow Charles, you and Chris to provide some commentary here. But on the far right there, you see some bar graphs. You see sales increasing, and this is a quarterly chart. You then see operating margin. You see that also increasing. So low left to upper right, that's good. That means it's increasing. And then also return on invested capital. How management is making decisions with the profits that are earned from having higher sales and higher profit margins. How are they reinvesting that? Are they doing that in a capital efficient means? So we're not going to get into specific names of these companies, but I have a couple of questions. But before we actually get into these questions, what exactly do these charts show you? How do we identify, or what does it mean when we find a company like this when whittling down thousands to a much smaller list?
Real quick, I'll give a shout out to our Director of Research, Dwayne Bachok, who puts this together, and this utilizes Bloomberg data, Excel, and ports it into a Tableau dashboard that shows a tremendous amount of information that's below this in addition to what's in that chart. And you also see valuation on here, where earnings estimates, where the street thinks earnings estimates and such are moving. So this is part of a proprietary system that we use internally to manage all of our models and strategies here. But what we're looking at is it's showing that for that particular company, which and we're not offering investment advice, specific investment advice, but you can imagine that this is a fairly well-known AI-focused company that provides tools to businesses that utilize artificial intelligence. That's seeing a year-over-year acceleration in growth of sales, selling more product. They're selling it at a higher price, and they're reinvesting it back in the business to develop the next generation products that generate even higher returns. So it creates this flywheel effect.
And so when we identify a chart like this, and this is a really, really good example, and that's why we picked it, because on camera it's very easy to see that the trend in increasing sales, increasing margins, and also return on invested capital. It's not always quite that clear, and there does take some experience and expertise involved listening to, this is where not just the quantitative side comes in, but also the fundamental and the experience. But when we find a company that has charts like this is what we say, okay? This is a winner. This is something that we want to own. We want it in your portfolio. It's one piece of the larger puzzle. Now, conversely, not only does this quantamental process identify companies that we want to own and have inside your portfolio, but it also identifies companies that simply do not meet the standard that we set forth for purchasing in your portfolio. Eric, could you go ahead and pull up the SMR short table, please? And I didn't mention this, by the way, Dwayne Bachok, he is in the chat tonight. He's the Director of Research here at Oak Harvest Financial Group. Very important cog in the wheel that really contributes in a tremendous way to making this whole thing work for us, for you. So Dwayne, I want to say thank you very much, but also let everyone viewing tonight know that Dwayne is in the comments. Whatever he types, we may have to translate for you, so just giving you the heads up there. But Dwayne is there, so he's going to provide not only maybe some answers to your questions, but some insight and commentary into what Chris, Charles, and myself are talking about tonight. Okay, so Eric has it up, and here we see quarterly reports. And again, this is our proprietary data. So Dwayne goes out real time, grabs data from multiple different sources, pulls it in, and creates these tables to help us do our jobs better. So we see kind of flat sales, but we do see, if you were to kind of draw a line, you do see slightly decreasing sales, obviously decreasing operating margins, and then a clear trend with return on invested capital. So tell us a little bit about what this chart means.
So you'll also notice that in the tables on the left, that analyst estimates are coming down, valuations pretty high. So again, not offering investment advice, nor is this necessarily a current holding, but this shows us that the manufacturers of electric vehicles are facing some pretty stiff competition currently, lowering prices. Government subsidies might go away. There's some concerns here. That's being reflected in the numbers. This typically does not make for a good stock price.
And therefore, we not only have gold bars inside this universe, but we also have some of these. Okay, so when we identify these, what, I'm going to jump maybe a little bit ahead here into some of the hedging strategies and some of the more advanced strategies, but the quantamental process, identifying proven trends of corporate profitability, sales, margin, and return on invested capital, not only helps us to identify companies that we want to own, but it helps us to clearly identify companies that we do not want to own. And that in and of itself does, from an advanced trading standpoint, present some opportunities.
Yeah, I mean, we have multiple tools here for our advisors at Oak Harvest, whether it's dividend growth or a growth portfolio. We also have this new strategy that has the ability to go long, short, and hedge. And so when we find companies that have deteriorating fundamentals, not only have we the opportunity to sell them out of our portfolios that just own longs, if we own them there, we can actually now take advantage of the situation. And we have a tool that can short stocks and make a negative bet view outcome on a company.
And I think it's important to point out that whenever you take or you express an opinion that you believe that stock is going to go down in price, it doesn't mean that that's a bad company.
It doesn't at all. It doesn't mean it's a bad company. We're talking about the fundamentals of a stock. We're not. The people who work for the company aren't bad. The management team's not bad. We're only talking about the financials of the stock.
And that's the job, right? Identify companies that are
100%.
increasing sales, margins, return on invested capital in hopes of taking your capital and making strategic allocation decisions to increase the value of it over time. And the U.S. stock market, international markets, but its capital markets in and of themselves have proven to be tremendous wealth building mechanisms over the course of history. Now, the key to that, of course, is to identify and be able to separate good opportunities from less good opportunities. So just because the stock itself may be one of these, it doesn't mean that it's a bad company. And as a matter of fact, we have an example right now of Microsoft. And Microsoft is a tremendous company. Our director of marketing, our chief marketing officer here, worked at Microsoft for 15 years. And if you could go ahead and pull up that chart, please, Eric. What we want to do now is give you a very, very good example of what we consider to be a very good company, but it was, at a certain point in time, a very poor stock.
It was a horrible stock. And it took me 10 or 15 years of being in this business to figure it out, finally have the eureka moment about, it's not about a company's valuation, it's not about a company being good or bad, it's literally about the company making money, cash money, and what they do with the next dollar, right? And if you look on the left of that chart,
But first, let's give a quick overview. So this is, how many year chart is this?
I think it's 30 years, I think.
So this
it's
is
30-something years of Microsoft.
This is a 30-year chart. So what you're seeing, and then the peak right here.
It's Microsoft during the 80s. It's Microsoft into the dot-com bubble, which is where the stock peaked in say, late 1999, 2000. And if you're old enough to remember, like myself or with Charles, Troy's too young, but people were going out and buying PCs.
Just for the record, I'm the young person here, so just for the record.
So, and Microsoft's business model was Compaq, Dell, HP, IBM. They ship you a computer, and they don't make much money on it, but Microsoft software is installed on it, and they get $100. It doesn't matter if IBM loses money on the PC or not, Microsoft mints money. So they're taking in all this cash. And what happened is everyone finally, their growth rate peaked, I think, in Microsoft. In this next table that we have, that Eric will put up in a second, you'll see their revenue growth peaked at like 29 or 30% year over year.
Yeah, so just to summarize real quick, so the peak of the chart there, you see the line, the peak that's late 1999, 2000, that's the peak of Microsoft stock price. And then you see, I can't make out the years, but it looks like for 15 years, 16 years,
it's
basically
15 years.
flat.
It's basically flat, even though Microsoft grew their revenue almost every year. I think they had one or two down years. They grew their revenue at double digits, teens.
Go back to that chart here.
For 15 years. Right, and the stock went nowhere for 15 years. And
the other one.
Management team at the time was Steve Ballmer. Nothing against him, but they were trying to find their next act. Right, they were trying to find all this money we're taking in for essentially free because people are buying PCs and Apple, or not Apple, but Compaq and Dell. Everyone's writing us checks. What do we do with this money? And they couldn't figure it out. And the stock went nowhere because their marginal return, every dollar they got, earned less money than the previous dollar until something called
subscription services.
Subscription services and the internet turned around, right? Yeah. Which was 15 years later, and instead of selling Microsoft Word or Microsoft Excel, they said, hey, we're going to charge you $10 a month, or I don't even know what the fee is, and that business model started giving them visibility every year, and the internet, and now AI and everything else, and they had an acceleration again in revenue.
So let me give a quick summary of what we're seeing on the table here. Eric, if you can make that just a little bit larger, please. So this is only a chart of revenue from 2004 through 2023. But what I want to focus on here is the revenue from 2004 through 2015. Because that's roughly the 15-year period of the chart that we just looked at, from the peak of the Microsoft stock price to where it kind of went down and then started to finally pass its last high back in the late 90s. And we see revenue on the surface from 04, this doesn't go all the way back to 99, but from 36 billion to 93 billion over that 11-year period. Do we have a chart for profit margin or return on invested capital?
Because it all starts at revenue, right? And on the far right column, you can look at the revenue growth on an annual basis, and you'll see it's growing at high single digits, double digits, but it never exceeds like 29, I think, percent it had during the dot-com bubble. So they're struggling, they're growing. It's a great company, but they don't know what to do with all the cash, which is a great problem to have, but
they had an identity crisis, right?
They did, and they lost out to Google. They lost out to a couple other things in the internet, and the stock went nowhere. And there's other companies like Walmart, great company, went, I think, almost the same time, 15 years of nowhere, when instead of growing in the U.S., they decided to go over into international markets, which have different labor rules, different real estate costs, different taxes, and you just have these massive periods where you're like, I could just own the S&P 500 instead. Yeah. So we're looking for those inflection points where, after investing for a couple years or a couple quarters or a couple decades, the investments start to take fruition, and the company's marginal return on invested capital starts to go up, not down.
And the point here that we're trying to make, and I got a question for you, Charles, the point here we're trying to make is companies necessarily aren't bad, but sometimes the stock can be bad. So if you think back to what Microsoft's potential was during that time versus what the stock actually did, what we see there is increasing revenue, but at the same time a company struggling to really decide or really determine how to increase profit margins and then take those profits and reinvest into other business units to create ever expanding margins and ever growing sales and profits. So they figured it out finally, and just the summary there, if you guys remember, and I know many of you watching do, like Chris said, every computer you bought, Microsoft came pre-installed, or you had to go and buy the package. I remember like $399, and you get Microsoft installed on the computer, and then that was it. You never paid them again. And then finally they said, you know what, we're going to make this hard decision to transition to the subscription model with Microsoft Word, Outlook, all of those services, and now you're paying annual costs, and they kind of started to find their place there. So great sales, as far as great increase in sales there, one component of SMR, but the other two components really weren't coming to fruition, and that's one of the reasons why Microsoft stock didn't go anywhere for 15 years.
And can I?
Yeah, please, go ahead.
Yeah,
No.
so okay, I wanted to say two things really. One is it relates to what you guys have just described. We have a lot of clients come in, well, why are you trading these securities in my account? I'm a buy and hold investor, right? Well, we're not, right? And that chart pointed out why you shouldn't be. Because why do I want a 15-year period of dead zone in my portfolio, as opposed to us who are always looking where do we reallocate? We would hopefully sell that position, reallocate it into a higher returning investment. And that's the benefit of active management.
Yeah, it comes back to, so if quantamental is kind of the high-end philosophy that we employ here when identifying companies that we want to invest in, some of the more nuanced aspects of the entire process is having a disciplined exit strategy.
Agreed.
So at some point, it's being able to admit, you know what, I was wrong. And this capital is better deployed into this alternative idea where sales, margins, and return on invested capital is increasing at a greater clip. We believe this gives us a greater probability. No emotional attachment to the company whatsoever. You're not going to bat 1,000.
Right.
At the same time, being able to make those tough decisions without any emotional attachment oftentimes is what separates people who make money versus people who do not.
And to follow up on that, and maybe to put the final point on that, is when we refer to SMR negative, which is what you just sort of described, right? You're thinking in those sorts of terms, and having the ability, the strategy that we've created here allows us to express a view on that, right? And so there's no good reason to exclude this whole large section, opportunity set within the market, just because you don't have the structure to do it. We took the initiative to create that structure and build it, and so now we can take advantage of that.
To help drive profit as opposed to just letting the opportunity waste.
Agreed. And then if done properly, and I think maybe where we're headed next is that allows us within the strategy to adjust overall market exposures and create some of this hedging mechanism that I know that we're going to talk about in a bit.
So we now have this tool that we talked about before that is a product, but on the negative side that we can actually now use, I like to bring up, and we have no position in the company, is Peloton, because if you remember back in COVID, in Christmas of 2020, Peloton had probably one of the best reputations in the world, right? I mean, everyone I know wanted to buy their. It was a $7,000 treadmill.
I'm going to be stuck at home for the next.
I'm going to be stuck at home, and backlogs of 6 months, 18 months for these treadmills. And the stock went to like 120 or whatever. And it's the type of company you're like, their marginal return on invested capital when they go out and they order 20,000 treadmills from China at the peak of COVID, and all of a sudden, they have $200 million on their balance sheet. As an analyst, you're like, no, this is going to be a problem, right? Because they sell treadmills, right? As good of a company it is. So we now have a tool on the other side of SMR that can actually take advantage of this deterioration that we see in certain companies, whether it's a Peloton in the future or something like that.
And we got to move on to hedging, but real quick, I want to point out that part of the fundamental side of things is, it's a really good example. So Peloton, and you think Zoom as well, although that's starting to look a little bit better right now. When you see a certain dynamic or circumstance take place that creates this massive increase in sales and profit margins, but it was created by some circumstantial event, as an analyst, you look at that and you say, you know what, I don't think that this is durable, right? I don't think that sales can continue to grow at this rate, which doesn't take a genius to figure out, but at the same time, you get a lot of greed, and they want to ride it up, and now the stock's going here, everyone on TV is the stock's going to keep going up, but when you look at it objectively, you say there's no way that they're going to continue to grow these sales at this rate. However, the stock is currently priced, obviously is not durable. We have to look at this objectively.
Agreed. And the psychological effect that most investors have is that we'll all realize it on the way up, and we'll see it in the numbers, and you'll know that you have to be long this name. But as soon as you cross and come over that peak and come down, and that SMR chart starts going down, then people start saying, "Well, I really like it. They make a really good product." And they just hang on to it, and they end up writing these names.
The emotional
down.
justification. So
Exactly.
I bought it at 80. It's at 75 now. I just want to get back to even.
Right.
Right.
Bad, flawed methodology.
The stock
and thesis.
doesn't care because there's people who have a lot more money than us who are like, hey, business is getting worse, not better. We're selling it. Oh, and it's getting worse, even though it's not bad, right? The company's not going bankrupt. It's just not as good as it was. You just keep selling it, and you keep hoping to recover back to your price, and it doesn't happen.
Hope should be part of all of our lives, but never part of our investment philosophy.
Fair enough. Okay, so we have our very first raffle coming up in about 3 minutes. But before we do that, I want to talk a little bit about what's coming up in the second half here. So we're going to talk a lot about what hedging is. You guys go ahead and, if you want to go ahead and run the raffle here, we'll probably have it in 2 minutes, the first raffle. And just as a reminder, we are going to have another raffle at the end of tonight's program. I haven't even got a chance to come around and look at any of these comments yet because we are having a really, really good discussion, but I'm going to hop into the comments and we're going to be interactive with you in this second half. We're going to have a good conversation. I'm going to come over here. So if you do have questions, if you do have comments, we're at the part where we're going to start to converse with you. So please go ahead and get them out in the comment section. But what we're about to get into is what is hedging? What is it from a fundamental standpoint? How can we implement a hedge in a portfolio? Options, shorting, looking at different tools that the financial markets make available to you to potentially mitigate risk inside of a portfolio. So do we have our first winner?
Yep, we do.
Who is it?
Gordon Bowen.
Gordon Bowen. So congratulations, Gordon. You are the winner of tonight's first raffle. Heather from our marketing team is going to reach out to you, and she is going to identify your favorite restaurant and coordinate the delivery of that gift card. So, Gordon, thank you very much for tuning in. Thank you very much for being part of tonight's show, and hope you enjoy dinner.
Yeah,
Gold bar for
Gordon,
Gordon.
That's a
Gordon
winner.
gets a gold bar.
Okay, so what I'm going to do is, Charles, I'm going to throw it over to you as far as what exactly is hedging, so we can create a foundation of understanding here to move forward. And while you're answering that, I'm going to look at some of these comments and we'll go from there.
Okay, great. So right, what is hedging? Right, in the most basic framework, it's a risk management strategy that's used to protect the value of an investment by taking an offsetting position in a similar asset, and it's a way to help mitigate risk.
Okay, so Juan Yu, just want to say hello. Thank you very much for tuning in. Just saw that you're coming to us from Las Vegas and you are a client. So I was in Las Vegas in January, and it's the one city in the world that I love to go into, but I love to leave even more.
Yeah.
So how you doing, Juan Yu? Glad you joined us tonight. And one thing I want to talk about here, which I think we're going to get into a little bit more, is the difference between your gross long versus net long. Because really what a hedge is trying to do is it's something that can be dynamic. It's something that can adjust as circumstances warrant or as we feel necessary or you feel necessary. But you can be, let's say, 100% long in the market, meaning you're 100% stock. But through hedging, what you can do is, without having to sell any of those positions, like a temperature in a thermometer, you can reduce or increase your net exposure to the overall stock market. So,
Yeah. So, I'm sorry.
No.
Oh, it was just sort of, to get through some of the terminology, perhaps, right? We were talking about what is your net exposure. Well, if now you have created a strategy that allows you to be long a certain number or amount of positions and then be short a certain proportion, let's think of it that way, positions, right? So say we're 75% of our funds are invested in stocks and 25% are stocks positions sold short, right? Your net exposure is 50%. So we've reduced our economic exposure to the market. Now,
real quick, Charles, let me jump in, because I think this is an important point. Through the SMR process, when we identify one of these turds, it not only, we consider it to be a profit driver, because history tells us that companies with declining sales margins and return on invested capital, those stock prices tend to depreciate over time. So not only do we see it as a profit driver that can contribute to expected return, at the same time, being short with that particular company can also reduce risk.
That is a really important statement. That's a differentiating factor about what we've always done, because it used to drive Chris and I nuts, because hedge fund managers were really a bunch of long-only guys sort of hiding behind the mask of that label, and a lot of them merely put on these opposite positions to create some sort of portfolio level effect. We said, no, we're not going to do that. That's diminishing the value of this research process. We're going to create a structure that allows us to express this view with the anticipation of making money on the downside in names to add value in addition to the natural hedging effect that it has within a portfolio. And that's something that we have actively done in a very large institutional framework at our previous firm.
So, Chris, I want to throw this to you. What's the benefit of hedging versus just, you see all these storms on the horizon and let's just sell everything and go to cash?
Yeah, well, so I first and foremost, as the investment team here at Oak Harvest, we have no idea. I don't say we have no idea. We don't know everyone. We have thousands of clients now. We don't know every client's financial situation, right? We don't know if you're 35 or 75. So it wouldn't be within our fiduciary duty, Charles and myself and the rest of the team, to all of a sudden say, hey, we think the market's going to have a downturn, whether it's 10% or 20%. We're selling all your stocks and going to cash. The financial advisors, it would totally mess up their financial plans.
Yeah, just to clarify that. So some clients are completely fine seeing the market go down because we have an agreement that we're long-term buy and hold investors, and the investment team doesn't know that about you. So if they were to go and make that unilateral decision to just sell everything inside that individually managed account without knowing exactly who you are, that would be bad. That would not be a good thing.
And some of the clients are taxable accounts, some are non-taxable accounts. We'd be getting a lot of phone calls about, why did you recognize hundreds of thousands of dollars of gains, just because you thought the market was going down or whatever. But yeah,
we would be in that hypothetical situation. Yeah. So what we've done is we've created a strategy where your particular advisor can say, have that conversation with you and say, you know what, here's the deal with this particular strategy. When the investment team wants to use their expertise and experience because they see things brewing in a certain way or just on an ongoing basis to mitigate risk, we're going to allocate X amount to this particular strategy, and this is how this strategy works. So we are going to make those tactical movements based on your experience and expertise versus the normal, let's say, long-term buy and hold growth portfolio. Previous to this strategy, we wouldn't do, because that would not be acting in everyone's best interest, because you guys aren't familiar with the details of everyone's particular financial plan and circumstance.
Yeah. So now we have a tool, the advisors have a tool to allocate part of our clients' money into, such that Charles, myself, the rest of the team, if we see tactical market opportunities, we can hedge, if the market's up and we're expecting an event. If we see single stock opportunities where we think there's going to be an event, whether it's earnings or some announcement, we can trade around that. And we are not worried about, oh my gosh, client XYZ is going to call me because I recognize $25,000 in gains, and they're going to be mad at the end of the year on taxes.
So getting back to the question here, and also kind of what you said, Charles, there. So really what hedging does, it allows us to continue to own the positions that we want to own for the long term without being forced to sell them, while also reducing what we can't control, what's known as systematic risk or market risk. So, getting back to my original question, why is hedging considered, why would we consider hedging to be a better potential solution than we see these economic storms brewing on the horizon? Let's just sell everything, go to cash, and go have a beer at the bar and wait for this to pass.
From a tax perspective, it's more efficient. From a capital perspective, I mean, we were talking just before we came in here about a trade we put on in one of the strategies today where I think we spent pennies to get the exposure of one of our tools down by 15%, right? So instead of selling 15% of the fund, we're like, hey, we can go out and hedge and buy a little bit of insurance, just some puts or just a hedge to mitigate any downside that we see over the next month, 2 months, 6 months.
Well, in this case, yeah, we went quite a ways out.
Yeah.
So what you're highlighting is a different efficiency, is operational efficiency. The ability to execute a strategy like this is easier to do within certain types of structures.
Yeah. And the answer I was looking for you, Chris, is because you have to get it right twice.
Yeah,
well, that's true too.
Yeah.
Well, actually, you're at 3
Yeah,
times.
you have
but
to do different decisions. Yeah, and so let's sort of cap this and say, capital efficiency, the ability to do it at a very low cost. Tax considerations are always at play in separate managed accounts. The operational efficiency that occurs, but then the way that we do it and the strategies that we've developed are self-adjusting, right? So capital markets are very dynamic. So some people think, well, I can just I'll go and buy a put and place that position on, and that just doesn't work, right? It has to be to be effective. It has to be actively managed.
Yeah, not only that, it needs to be, the technical term here would be R squared, but it needs to be correlated, whatever you're hedging. It needs to be somewhat of a benefit, meaning if, you...
Right. Well, you think of the definition that we gave of hedging. What is hedging? And it's basically taking an offsetting position in a similar instrument that is completely uncorrelated, right? The best case scenario is negatively correlated with what you're trying to hedge. It moves in the opposite direction.
So if you own NVIDIA and you're concerned about its long-term prospects, you don't want to go out there and short a utility company or buy options on a utility company because there's no correlation there as far as...
And so it becomes very critically important to understand exactly what it is you own, what that looks like, how it behaves, and what that R squared that you brought up looks like, so that you know what the proper hedging tool even is on that strategy. A lot of people just don't consider that, and they wonder, well, if I own, I'll make the example a little bit more simple. I own, a whole bunch of tech stocks, but then I hedged with, the Russell 2000 index. They just don't match, so it doesn't hedge. What do you guys say? I can't wait to hear it now.
Hopefully this is a good translation. Usually people are translating for what I say. So if you shop at Louis Vuitton or Cartier, you don't return it at Walmart, right? So and that's what we're doing at the portfolio.
That's good.
We're
That's actually really good.
I thought it was. That's why I started laughing. What we own in the portfolio, if it's a volatile stock and has a lot of juice and gamma, and all these Greeks that we might want to talk about in the future, we're not going to go look to something that's really non-volatile and doesn't move around a lot and convince ourselves that, hey, we're hedged, which is what a lot of hedge funds and a lot of tools out there do, and what drove Charles and myself and the rest of the team crazy is that kind of messaging.
Yep. Hi, Mike, Mark, and also Barbara's mom. We will tell Nicole hello for you. So glad to see you guys tuning in tonight. Okay, now we're going to get a little bit deeper. So we've laid the foundation of what is a hedge. So ultimately a hedge is a strategy or an asset that you can use to offset the risk of your long positions inside the portfolio with the ultimate goal of reducing risk, right, without having to sell everything in the portfolio. Because if you sell everything in the portfolio, not only do you have to get the sell right, but you also have to get the repurchase correct. And nobody can time the market correctly 2 times over extended periods of time. And it's just a losing strategy. Okay, so kind of moving on here. Real quick, I want to get this done in the next 3-4 minutes and get into options, get into maybe some shorting, get into some of the tools that can be used to protect a portfolio. But when could a hedge be used, just in general, but then I think more importantly, does the size of the hedge ever change? Does it get bigger, smaller, and what would cause the hedge we put on a portfolio or that somebody could put on their own portfolio possibly, what would cause that to change?
Well, I mean, part of it is based upon a view you have of how much risk there is, right? Or so what is, in this case, let's keep it similar, what is our net exposure, right? And then so how much is the most prudent amount to leave on? And then you adjust the size of your hedge accordingly. And that can change, right? We always say capital markets are dynamic. So the value of that hedge, the value of that portfolio is always changing as the market's moving up and down. So you have to have a tremendous amount of experience in derivatives modeling, measure, manage, monitor risk in a real-time fashion, or else you're going to lose out.
Gives me a shameless opportunity to plug our upcoming live stream where we're going to provide a mid-year review, but also a second half outlook and a forecast. Because the reason the forecast is important is because that sets the roadmap for what you believe will happen. And having that hedge in place, or the forecast, is really a large part of determining how much risk you actually see is out there. Then as events transpire throughout the second half of the year, we can increase the size of that hedge to reduce the overall net exposure to the stock market without having to sell. But at the same time, if things are rosy and things are going well, you can either reduce the size of that hedge or possibly increase the overall net long exposure. So we want to have a hedge in place. Really, it's designed for people who say, you know what, I want to be long in the stock market. I want and believe in capital markets, and I want to make money. But at the same time, if markets start going down, I'd like to have a strategy that can potentially reduce my volatility, reduce my downside risk, without having to play this guessing game of when to get in and out of the market.
You want to be in a position where you can get invested and stay invested and not have to worry about it so much. Since Chris came up with this great analogy, mine is now that have a long trip in an airplane, right? And so we're okay getting on that airplane and flying, but if there's some turbulence, we don't mind going around it to get to our ultimate destination if it keeps the ride smooth. It might take us a little longer to get there, which is the analogy is that there is a cost of hedging, so maybe it does eat into your return a little bit, but ultimately, if you're right, you get to your destination with a smoother ride.
And if you're actively managing it, not just passively buying hedges every month, you can actually add some value over time, or at least mitigate the cost of the hedge.
Agreed.
Yeah, and that's a good point too, because there is a cost to it. It is a more costly strategy to employ than just simply buying an index fund, right, of the S&P 500. Because if you buy an index fund, you're going to get 100% of the market upside for the most part, and you're going to get all the downside.
Yeah.
The thing about having a hedge strategy inside the portfolio is in a market where it's going straight up, theoretically you should lag because there's more costs involved, and at the same time you have positions that are, for the most part, invested saying, if the market goes down, they're going to be profitable, but if the market goes up, they're going to be losers. But conceptually, when the market does start to go down and those elements of the investment strategy increase in price, one of the cool things that I believe can be a very valuable tool is to take the profits from that hedge, and then when prices are depressed, deploy that capital at prices where you would expect your largest returns on your personal invested capital.
The most fun I've ever had as a portfolio manager has been in being exactly in that position where all of my competitors are operating under duress. They have to sell stocks to meet redemptions. And that's when guys like us just go around and like sharks in the water, you know. And it's a beautiful thing. It's nice to be able to operate like as a tightrope walker and knowing that you have a net beneath you.
Yeah, and that's a good analogy, right? It's like having, to some extent, right? There's no guarantees when investing. You know, it's just the basic disclosures there. You have to understand that. But it is like, in a certain way, it's like having a net. It's some adjusting level depending on what the market forecast is, what the risk exposure that we choose to have, what that is. The net could be really close, you know, to the overall balance, or it could be way down here, which means we have a longer net exposure. Yep. Okay. No, go ahead.
Eric, I'm going to ask you to elaborate. In the way Charles, myself, and the team actually manage the hedge. Hey, Eric, you're a big rock climber. What's the apparatus that slows you down as you're falling when you're rock climbing in the gym on the wall?
The thing your partner's holding.
Oh, the belay device, right?
Yeah, but it's
Belay.
the automated belay device. There's a device that slows you, like as you're accelerating, it slows you down at a faster rate. And we manage.
You've been studying these metaphors.
We manage the hedge in that way, right? At first, the hedge costs you, if you're hedging the overall portfolio, at first the hedge looks like it's costing you a lot of money. But as the market is dropping, it's starting to expand at an accelerating rate, and it's starting to make you more money at a faster and faster rate. So it feels, even though the market's going down, it feels better and better to being hedged.
And it's a longer term strategy, right?
And it's an active strategy.
Yeah, it's an active
about the way
strategy
we manage
over
it.
time.
Yep.
Okay, so we have the next raffle coming up in about 10 minutes. We're going to be giving away a $100 gift card to your favorite restaurant. And you see it right there on the screen there. So use the QR code and register for I believe it's the newsletter, or it's to Chris's Stock Talk, which is his weekly YouTube video that he puts out talking about the markets. Really, really valuable stuff there. But we are giving away one more lucky winner, a $100 gift card. So make sure to register for that. That's going to take place in about 10 minutes. We have a couple pre-submitted questions that I will get into shortly if we don't have any questions in the chat box. And if I have missed anything, Dwayne or Corinne, if you could just kind of point it out to me, maybe copy and paste so I can get into those. But Charles, I'm gonna throw this over to you here. Options. Okay, so what exactly is a call option? What exactly what is an option?
Yeah.
And how can it be used either to be purchased or to be sold to create value, let's say?
It's basically a way to express a leveraged or leverage position in an idea, right? So it is the right but not the obligation to either buy or sell a security at a specific price by a specific time deadline. So it's a way to express a leveraged view. It can be a very capital efficient means of expressing that view.
And it also puts in place a defined amount of risk.
You know exactly what your losses can be, and it is 100%.
So I could go out and buy, let's say I wanted to buy 1,000 shares of XYZ at $10 a share. I could invest $10,000.
Right.
Or I may be able to invest, let's say, $500 and purchase the option to buy $10,000 worth of that company. So now I've only put at risk $500. Right? Now, so you can buy an option, right? That gives you an opportunity to express a view on a company at a much smaller investment, right? For the opportunity to purchase more shares at date and time. And price. I could also sell an option, correct? What is the difference there between buying an option versus selling an option?
Well, selling an option is a really good way to generate incremental income, help mitigate some of the single stock individual risk within a portfolio, and also reduce some of the volatility that occurs. So what that entails is if we've had a stock that's moved up quite a lot and it's, so
you buy it at 100, it's now trading at 200.
200, and it's done it in a fairly short order, and you ask yourself, well, would I be willing to sell that at $205 a share? If the answer is yes, then I can sell a call option against a portion of that position, and I will collect the premium that is the result, as opposed to paying someone for it. So I collect that premium. If the stock does go up to $205 within that defined time period, it gets called away. Whoever bought the call option takes
So you
delivery
collect,
of it.
let's say you collected $10,000 in revenue for
Right.
selling the option. You collect that $10,000.
Right.
But at the same time, now you sell the stock at $205.
Right.
So you've locked in a disciplined exit strategy for that particular company that you bought back at 100. And
Right.
guess what? If the stock goes down, it doesn't go up. Let's say it goes from 200 to 180. Now you've just collected that $10,000 of revenue, and you
Right.
still own the stock.
Right, and I help mitigate some of that downside
Help
and some of the
mitigate some of that
volatility.
downside, so help
the other,
reduce the risk.
And the other part of that, within the context of the strategies that we use, right, we mentioned that there's a cost of hedging. Well, we view this opportunity to sell call options against some of our positions helps offset some of the cost
Yeah,
of
because
hedging.
again, like we talked about earlier, there is a cost to hedging, and part of the strategy that we're talking about now, this is also known as a covered call strategy, where you own the underlying stock and then you sell the option to generate revenue. The downside is if the stock goes up and hits the strike price, you have to sell it at that predetermined price within that time frame, but you collect the revenue.
Right.
And that revenue helps to offset the cost of the hedging strategy that you put in place.
And we don't sell calls against an entire position. We only do it against a portion of it, so that we don't just cap out all of our upside.
That is the problem with what a lot of covered call strategies are out there.
Right.
So let's say, and we see this a lot here in Houston, we have a lot of people that own oil and gas stocks and have large concentrated positions in individual companies. And a lot of times we'll see some covered call selling there, or just in a general portfolio. And if you do it across the entire portfolio or a very large concentrated position, what you're doing then is capping your upside, right? You're capping your upside because if you really like the company from a fundamental standpoint, you have limited your upside. So there's a balance there. There's a delicate balance of identifying good opportunities, but then also making the right decisions.
Yeah, and in a more tactical trading active strategy like we have in this new strategy, I mean, we see it a lot of the time. You can see single stocks where people have sold calls on the stock with, I don't know, maybe 10% upside, and all of a sudden the stock gets up there and the stock goes above there. You can see it in the market. A lot of these people are like, whoa, I really don't want to sell the stock at 100, so they go back in and buy the calls, and the next thing you know, the stock is at 110. And, Charles and myself and the rest of the team, having had experience for the last 30 plus years, try to take advantage of situations like that where sometimes things get too far too fast, and we just wait and try to be patient and take advantage of other people's impatience.
So you see it, and then the price of those options increase in value. So it gives you an opportunity when you see the volatility spike to sell at a higher price than what the true determined market value is.
You have to have substantial resources and experience in understanding how to model these types of trades up, and particularly in the options. Yeah.
Yeah, this isn't on the subject.
Right. Well,
I can address it.
What a common question regarding we're sort of talking about generating income, but why not just do this?
we got a question. Can I address it really quick?
Please.
Question from someone out there. Common question from prospectus: why not just go buy MLPs, BDCs, which is business development companies, enjoy an 8 to 10% dividend? Because those aren't real. I will challenge anyone out there to look at the last 10-year return on any business development company group or MLPs that have 8 to 10% dividends, and what you will generally see is you're getting 8 to 10%, which is taxable in taxable accounts, and your capital is going down, down, down every year. This isn't a business development company, but AT&T is my go-to for this prime example, right? Not a bad company, not bad people, a horrible stock that's paying you a dividend very high, above market, and the stock goes down every year.
Well, yeah. So okay. So one thing to clarify there. So some of these do have tax-free dividends, but all they're doing is returning your principal to you. So it's a return of cost basis, and then when you sell the stock, if there is any gain, you pay tax at that point. But what I would encourage you, the simple answer here, do a comparative chart of the S&P 500 versus any of these MLPs, BDCs over the past 10, 15 years.
Total return.
Total return. So return is comprised of two components, the dividend component and the capital appreciation component. So when you only focus on the dividend, what's happening is you're foregoing the potential for the greatest driver of wealth creation in the short term. Now, over 50 plus years, many studies out there have shown that dividends can be more than 50% contributory to the appreciation in a stock's price. Now, we're talking about MLPs and BDCs here, which a little bit different story there, but you have a couple things here. One, you have a lack of capital appreciation. And if you do a comparative analysis, you're going to see a hugely divergent price of the stock from your MLP BDC versus what solid growth companies have done. But simultaneously, you run the risk, not only with that capital appreciation, but if those businesses slow down sales, margins, return on invested capital, then they have a cut in the dividend because they don't have the income to pay you that massive dividend payout. You're going to most likely see another significant crash to your principal. So now all of a sudden, you've lost 40, 50% of that investment, and now you're getting a 2% dividend, right? Because the income's not there. The business model has failed. Oil prices have went down. Go back and look 2020, right? When oil dropped to negative prices per barrel.
45.
You know, you're not going to see a lot of those companies perform quite well. But go back, look at a 10 to 15 year chart, compare it to any really good growth stock out there, and you're going to see you've probably lost 30, 40, 50% of value that you could have had otherwise. That's just a question we've received for years and years and years. And it doesn't mean that they're bad tools. It just simply means that putting 100% of your money into something because it pays an 8% or 10% dividend is it's a very bad decision, plain and simple. Okay, so we do have the winner to our next raffle. It is 7 p.m. So we have the winner to our next raffle. We still have 83 people on here. So we're going to keep going. Again, if you have questions for Dwayne, he is in the chat box. If you have questions for us, feel free to put them on there. I know this is a bit of an advanced topic, and many of you are just kind of listening and learning. You may go back and rewatch this. But please, if there are any questions whatsoever, we want to see them in the comment because we'd love to have a little bit of an interactive discussion with you. Okay, so the winner of our second raffle is?
Michael Willis.
Michael Willis. So congratulations, Michael. You are, and Michael, I saw you comment earlier there. So see, sometimes when you comment, you know, good things come back to you. But Michael, congratulations. Thank you very much for tuning in. Thank you for commenting. And Heather will be in contact with you. Heather is from our events team. She'll be in contact with you to coordinate the delivery of that gift card to your favorite restaurant. Okay, let's see if we get any fall off now that we've done the last raffle. And if that's the case, we have one more raffle coming up. No, just kidding. Okay, so real quick, guys, let's wrap this up, but let's talk a little bit about, well, first, I have a couple of topics that I'd like to get into, but let me give you guys an opportunity. Is there something, do you think, it's important that we cover at this juncture about hedging or anything we've discussed so far?
There's right ways and wrong ways to hedge. You have to have the tools in place to know what, before you can hedge it, you have to know what it is you own. It's all dynamic. It can't be purely mechanical. We see a lot of firms, name brand firms, that manufacture product that's easy to operate. It's just inferior. Capital markets are dynamic. This has to be actively managed. So it takes a unique
It's
skill
reflected
set
in the
to do
cost,
it.
right?
Agreed. Yep. Yeah. Kind of you get what you pay for a lot of times. So, but I think we've covered a good bit of ground. So.
Okay, so just to summarize here, so using the quantamental process, which is a combination of fundamental analysis, but also the quantitative side of things. We take this entire universe and whittle it down to a much smaller universe to identify companies that have increasing sales, increasing profit margins, and also increasing returns on invested capital. That's what our little bucket over here represents. So we have some of the companies that we consider to be, let's call them gold bars, right? They're in the universe of stocks that have been whittled down that we have identified as companies that we would like to deploy some capital into. At the same time, that process does identify some turds that may be out there because sales are decreasing, profit margins are decreasing, and they're happening over consecutive quarters. So these are not companies that we want to deploy, but they do represent opportunities where we can use them to not only add value and potential profit to the portfolio, but also they create an inherent hedge. So that's part of the shorting process. And again, there aren't necessarily bad companies out there, but you can be a good company and be a bad stock. We talked about this earlier with Microsoft from 1999 to 2015, where the stock basically did this, right? Great company, but it was a bad stock to own at that time because they weren't driving margins and they weren't reinvesting capital at rates that investors deemed worthy of investment. So we have one opportunity there through the quantamental process, but then also we have derivatives. We have these tools that we can use at a much reduced cost to either increase exposure to an idea that we really like, or like a temperature on a thermometer here, reduce the overall exposure that we have to the market without having to sell. Right. So if we use these derivatives to reduce our exposure to market risk, right, we don't have to sell those companies. We still own them, and if the market goes up, they should still increase in value, of course. But at the same time, you can reduce risk by reducing the temperature, the exposure that you have to the overall risk within the market. Yep.
Yeah, we had a question that was pre-submitted that asked, what would you do? What do you plan on doing with the coming 65% meltdowns in the market due to uncertainty and resets and all these things? If we thought that some event like that was coming and it wasn't a black swan that was out of the realm of prediction, right? We actually can increase our hedges and lower the exposure of the fund as opposed to just selling everything and sitting in cash. And
the downside to selling is if you're wrong, you've missed out on this great opportunity to participate in the market upside.
Yeah, which is like this year so far. I mean, I don't know how many pieces I've read, and we've done some YouTube pieces at the beginning of the year. There are all these soothsayers who have newsletters, and most of them don't manage money. Some of them do or have retired, that have called for crashes, and the market has gone from the market has gone from 4,200 to 5,400 since last October. And eventually they may be right, but they need to be right on price and time. Yep. Otherwise, they're not just early, they're wrong. Yep. In the world of real money management.
Yeah, because the reason I say Harry Dent, it's kind of an inside joke around here, but he's,
too inside.
If you say the market's going to go down for 20 years, eventually you're going to be right, right? You're going to hit it in this time frame, you're going to hit it in this time frame, but for the most part, you're wrong, right? Okay, so what I want to do now, we're going to go for about 10 more minutes. For those of you that are still here, we're going to do something special. So we're going to give you a little preview and a little insight into our June 27th second half outlook, because it ties into what we've talked about tonight. And I wanted to call it a tale of two quarters. So there's a little bit of bonus content here, but there is potentially a few events in the third quarter. Obviously, we have the presidential election upcoming, but there are a few events that could act as catalysts to move the market potentially in one direction versus the other. So it's not unreasonable to see possibly a 5 to 10% correction over the next 3 to 4 months. How would a hedging strategy in an environment like that, if that were to take place, how would that function? How would that benefit someone? What would be the pros, the downsides there?
change the script.
So
So far,
Yeah,
so far year to date, the first half has been. I mean, it's even been better than we had expected, right? I mean, and it's because there's been less volatility than we expected. Now, if you had told me last October that volatility would be where it is right now, I could have told you almost exactly where the market would be. I mean, that we do have a secret sauce, and it does taste really good most times. That being said, so this year so far, it's running in a regular presidential election cycle. The markets are up when they should be up. They're a little higher than they should be. Normally, you get a summer slowdown, right? It's a consumer-led economy. People go on vacation. Who knows? The capital investment from the IRA and stuff starts to slow down in the third quarter. So with the market,
we're coming off this.
We've had a big run up in the first quarter. I mean, it almost doesn't matter the excuse. Historically, into an election, from mid-August through mid-October, the market goes down. They can make up reasons, I don't know why. But we can actually, with volatility where it is, we can go out and we can actually hedge and buy some protection to mitigate downside risk during that time period very economically, right? We don't have to sell stocks we like if we think they're going to have good fundamentals for the second half. We can say, hey, insurance type protection is cheap through October. Let's go spend a couple pennies on the dollar to buy some.
It's a capital efficient means to reduce risk by hedging out potential downside events that could happen in the summer, and we have several, right? The Federal Reserve is a big one. We have the next NVIDIA report, which seems to, the entire market seems to be hanging on guidance that NVIDIA provides during their conference calls and quarterly reports. And of course, the presidential election, there's a lot of uncertainty around that, not to mention whatever unknown event may transpire in the summer. So when you're in a time like this, and volatility is so low, what that means is the cost to mitigate risk, the cost to protect your portfolio, the cost to hedge is extremely cheap, right? It's inexpensive. So when you have these events that could transpire over the next 3 to 4 months, and insurance to protect against those is trading at really, really low prices, the hedge can provide some comfort to some people and mathematically, definitely reduce risk in the portfolio. And if those things transpire, there should be a positive increase to the valuation of that hedge. And if they don't transpire, it's going to underperform, right? It's going to underperform because there was a cost to it. But at the same time, there's the value in, hey, if something goes south, I have this protection in place.
It doesn't cost you a lot, and this is a shameless plug for the YouTube release tomorrow. It's called Summer 11 Tactical Trading, and it's a plug for our outlook for this year and kind of the second half. But at the same time, it's a promotion for our services at Oak Harvest and us being a retirement planning shop first, and that we have clients, and I've been here 6 years, been through COVID, been through the Christmas Eve 2018 plunge of 20%, and I think I have a pretty good feel of a lot of our clients on a retiree and near retiree basis. If you get anxious when the market is down, now is the time to actually give Oak Harvest a call and talk to an advisor, whether you're a client or not, set up an appointment and talk about your asset allocation, because volatility is low and because the markets are up. If you call us in October and the markets are down 10%, it's not too late, but it's a little too late, right? The time to do asset allocation is when things are calm, when there are no storms. The time to buy insurance is when no one else is and it's really cheap. Get on the phone and give us a call now. Schedule an appointment with Troy, with your advisor, or if you're not a client, over the next couple months, and we can look at your plan with another advisor and say, hey, you've got a lot more risk than you think. Maybe we can affect some change to mitigate that. If you are the type of person who gets scared when the market's down.
Or you're the type of person that when the market starts to go down, you want to sell, you want to protect yourself. So the time to do that is not when the market's going down. The time to do that is in a period like right now, when volatility is really low. And the entire point of what we've talked about tonight is to have, when you have a financial plan, and I call it guardrails. If you're comfortable seeing your account go down 10% or plus 20%, let's say that's your guardrails, you want to have an asset allocation, an investment strategy that mathematically this is your range, right? Nothing's guaranteed. Theoretically, you can go outside of that, but in most scenarios, you're going to be within this range. If you have that correct, if you have some congruence with your willingness to take risk and experience risk and stay committed to your investment strategy and how your investments are actually invested, you shouldn't ever have any concerns no matter what the market's doing, because you have an investment plan that fits your comfort level, your comfort zone. So that's number one. Number two here is what we've talked about tonight is a strategy and a way to allow you to potentially reduce risk while staying invested and not worrying about some of these big events that could possibly transpire. And that's the thing, is we don't want to get into the guessing game of I should buy now, I should sell now, I should get in, I should get out. Because when you do that, you have to make consecutive decisions that are correct. And the consequences for being incorrect with either one of those entry or exit points typically can be hundreds of thousands of dollars for most of you. We've seen it be millions of dollars before. You know, get on the phone, Troy, no matter what, we need to get out of the market. Worst thing you can do, I don't care, Troy, it's my money, listen to me. Okay, you know, sometimes it happens the very next day, right? The market goes up and, you know, you made a decision, you made an emotional decision. So our goal is to help put some parameters in place, put a structure in place, and provide tools that can help enhance the viability of the plan that we have in place. And that's really what we're talking about tonight. So great point, Chris. I want a couple of good questions here that come in. Does Oak Harvest have option accounts within general accounts? This comes from Young Martin Associates. I hope you're still here. Came in a little bit ago. I think what you're trying to say there is, do we trade options inside individual accounts? No, we do not, because we have thousands of individual accounts, and that would be tremendously costly, inefficient, and not in your best interest. But what we can do and what we have done is create a strategy that allows us to use the investment team's expertise and experience to be able to maneuver. And if your advisor and you have an agreement that this makes sense as part of your overall asset allocation, that's automatically going to be taken care of for you. So there's that. We have JMG. Growth versus dividend income versus hedged investment strategies, which is suggested for after-tax accounts. Thoughts on having diversified investments strategies across accounts? So many different ways. I'll take this, guys, if you don't mind.
No, it's
a lot of different ways we can go here. This is definitely something that we would want to have a conversation about. Dividends and after-tax account create taxes. Long-term growth, if we're looking at straight tax efficiency, is going to be your best choice, because that's something we're going to buy and hold. The economic storm's on the horizon. We're not going to go and sell, because we plan on holding that position for 3 years, 5 years, 20 years. The tactical strategy in a taxable account can create some tax consequences from maneuvering as the investment team sees fit, given the economic circumstances. So hopefully that provides a little bit of insight here, but the most important thing is this is what our retirement success plan is about. It's the integration of an investment strategy, an income strategy, and a tax plan. So typically what we would do in that situation is put the tools, dividend income, growth stocks, hedged equity, put those tools, financial tools, in the appropriate accounts based on your comfort zone for taking risk, with your desire to generate income, your ability to withstand the fluctuation and volatility at the most tax efficient mean that we see possible. Okay, so that's a lot to swallow, but hopefully that made a lot of sense. So it's a case-by-case basis, but those are some of the considerations that go into not just your question, but the overall philosophy here at Oak Harvest Financial Group. One more question from DGM here, DJM. How do you use price of a company into the equation of buying into a company you identify as being who you want to invest in. I think this is a question about valuation.
Yeah. We use price and earnings. That PE ratio is a traditional method you would use. So you don't use, just price alone.
You don't. I mean, this is a soapbox of mine. Valuation is a horrible timing tool, right? It's a great long-term timing tool for the overall market, but for individual companies, it is a horrible timing tool because you will, if you're constantly looking at valuation and a company's business is improving, you're going to say it's too expensive. And the next thing you know, as we've seen in the AI market, demand has exploded the last year and a half. And the company stock has gone up 5 or 10-fold. And oh, by the way, the earnings have also gone up 10 to 20-fold. And what looked expensive last year now looks really cheap this year. Or vice versa, a company which is a value trap, it looks cheap, but they keep reinvesting the money at lower and lower valuations, so that at lower and lower returns.
Yeah.
So the stock just keeps going down. So, I will say it until I retire out of this business. Valuation is a horrible timing tool. That doesn't mean you throw it out the window, but if you come to me and we start arguing or discussing, hey, this is 25 times 35 times, I'm going to walk away because it's just it doesn't
literally
work.
You will see steam coming out of his ears.
It doesn't work.
Yeah.
I mean, because you would have sold the leadership companies 2 or 3 years ago, and you'd be left holding a bunch of dogs.
Agreed. Yeah.
And so here's the thing. So and then one of the responses we make here is, well, Warren Buffett. Well, here's the thing. Warren Buffett is investing for 50 years, for 100 years. You most likely don't have 50 years to wait for the identification of value within a corporation to come to fruition. You're probably going to fire us after 2 years if you're in a bunch of stocks or companies that are we tell you, hey, these are great values, but meanwhile the stock market's going up here and you're not participating in it. So DFA, Dimensional Fund Advisors, tremendous research, Nobel prizes. You are right for this particular question in the sense that over long periods of time, we're talking multiple decades, value does tend to outperform growth. But over the past, let's say 15 years, value's been left in the dust. You could own companies that are identified as extremely value-oriented, and meanwhile, you're going to be pretty upset because everything that's growth-oriented has lapped them 6-7 times over.
Yeah, and
hyperbolically kind of.
Having been a growth manager for 30 years, I argue with my value manager friends that we're looking at the same things, right? There is no value manager that I know that buys a stock that says, hey, I hope it goes down another 5, 10, 15% for the next 10 years. I'm going to just keep buying it. They don't. They buy a stock when they think it's a value, but when business is going to bottom or turn. So the growth manager is generally a little more skeptical and says, hey, I'm waiting until their business starts to turn, and I don't mind missing the first 20% because I want to be on it for the next 50, 100, 200%, whether it's Apple or something like that, multiple years. The value, the deep value guy, which I don't know anyone left in the business that literally buys a stock and says, I'm okay holding it, and it underperforming the market and the rest of the economy for decades. Warren Buffett doesn't do it. And remember, Warren Buffett, too, also has billions of dollars of additional capital coming in every day.
Not to mention billions and billions sitting in cash.
And billions is sitting in cash. And he gets special deals, right? During recessions, people call him up and say, hey, invest in my business. I'll give it to you for 10% less than everyone else in the world. So unfortunately, we're not Warren Buffett. He's been the most successful individual investor there is, but he's an anomaly.
And I remember reading something, I don't know if this is true or not, but I remember it was about 10 years ago, may have been on Seeking Alpha, where it was about a 10-year period where had negative returns, right? So if you're a value investor, the truth of the matter is you're investing you don't know when that value is going to show itself, right? And it will be reflected in the price of the stock. It may be 5 years, it may be 6 months, it may be 15 years, right?
value is an interesting word. It's interpreted differently by just about everyone you ask, and we're, Graham and Dodd, the father, Benjamin Graham, whatever, the father of value investment. Well, his primary premise, I think, was just looking at things that had a sort of margin of safety in them. And we look at things the same way. We're sizing them up, sort of what's the risk reward here, and if it's a leading business and the valuation is a little bit expensive, it's not a huge influencing factor if we think it's going to continue to do well.
Yeah, that's a great point. Because you still want to buy things at a discount to, what you feel they're.
Believe right, we're as growth investors, we're buying an expected, a stream of expected, future cash flows and profits, and so we just have to do a better job of sharpening our pencil and figuring that out, what that looks like.
I mean, because Microsoft didn't do anything for 15 years, and they were making money, and it looked like a value. I mean, it was relatively inexpensive, but each dollar that they were taking in, they were earning less money on.
Right.
And the market is super smart, right? I mean, you might as well have just been in an index fund for 15 years, and then they changed their business models to subscription. This little thing called software for service came around, and now they're AI, and the stock's been fantastic. But value of the beholder.
So Coco, I hope you're still here. You asked a really good question here. It's at least a great opportunity to kind of point out a big differentiation between what we do here at Oak Harvest and some other places. Coco says, that's a great explanation, Troy. I often wonder how the intelligence that's occurring with the investment team transcends or translates to the advisors helping to manage the individual client funds. So that's a huge thing here. Advisors don't manage funds at Oak Harvest Financial Group. One of the things when I started this company, when I saw how look, here's the thing. Most financial advisors, honestly, couldn't sit up here and have the conversations that we're having right now. I always try to be polite and not use words that I'm going to regret. But, Grandma always told me if you don't have anything nice to say, don't say it at all. But here's the truth. Most financial advisors shouldn't be anywhere around your portfolio as far as managing funds. Managing it, they shouldn't. There are a lot of just salesmen in the financial industry that now have this financial advisor label slapped on them. So when I started this company, one of the core beliefs that I had was that financial advisors will not be responsible for managing money, because I know too many who have absolutely zero qualification and skills and the ability to do that. So once you make that decision in this industry, you have two choices. You can outlay a lot of capital to bring in your own investment team, or you can go out and find third-party asset managers and money people and then pass that cost to your client. And we did that for actually the first 6 months when we opened our company. And I didn't bring, I think I brought 1 or 2 clients on, and I stopped because I didn't feel comfortable saying, I'm going to charge you, let's say 1% for this relationship, but at the same time, this other investment manager is going to charge you 1%. It didn't feel right, because that 1% in the middle was a hidden fee for the most part. So you find an investment firm that, in my opinion, does not allow the financial advisor to manage your money. Because in my experience, they're just not qualified. It's not their expertise. To really be a good financial advisor, you have to be good at relationships. In this industry, to survive and to be profitable. But you need a team behind you that can do the technical work, that can do the planning, that can do the taxes, can do the investments. So long answer here, but I think it provides some context as to who we are and who Oak Harvest Financial Group is. So as far as the portfolios that are managed, our advisors have nothing to do with that. What they do have a responsibility is to identify what's important to you, what your income needs are, what your tax strategies are, what your comfort level with risk is. We call it your risk willingness, and then work together in a team to construct a portfolio using the tools that the investment team manages to accomplish those goals. So long answer, but I think that's some really good insight into who we are and what really separates us from many other firms out there.
I do have to say, because don't underestimate the interaction that our advisors have with the investment team, because we sit in the same offices. They can walk back. A lot of times they'll bring us a client or a prospectus portfolio and say, hey, this person's coming in. What do you think of this portfolio? What would you guys look to implement going forward if they came on as a client? we'll look through the portfolio. There might be 150 names. You know, we cross out names, we add names, and meet with the advisor. So then the advisor can go back to the client or the prospective client. So there's still interaction between the teams. It's cooperative. They focus on their main area of expertise. We focus on our main area of expertise.
Yeah, we hire planners, right? Our investment advisors, their expertise is in planning. But even here, we don't have one investment advisor that I would trust to step into Chris's shoes. We would never ever let an investment advisor manage portfolios. We hire people that have the expertise and experience and credentials, certifications. Lack of hair is a big defining characteristic we look when we're hiring people on the investment team. Because if you have hair, you haven't been through the mud.
Yep.
I told people that for 20 years. If your advisor has a full set of hair, they're not managing the money.
Yeah.
So, okay, with that, we're going to go ahead and call this a night. But Coco, thank you very, very much for that question, guys. I hope this has been a very informative conversation tonight. June 27th, we have the mid-year review where we're going to look back over the first 6 months of the year and also look forward to the second half. We may call it the tale of two quarters, where we have some really dynamic events that could take place that will impact your retirement. So mark it down, June 27th, 6 p.m. live stream right here on YouTube. And we're going to talk about the presidential election, the third quarter, the fourth quarter, and how it impacts your retirement. But thank you very much for tuning in tonight.